Welcome to The Power of 12, Fixed Income Insights, a podcast where we explore how investors can look beyond returns and build portfolios designed for resilience and consistency. When investors think about wealth creation, the spotlight usually falls on equities. They're exciting, visible, and often dominate market conversations. But some of the most successful portfolios aren't built on growth alone. They're built on balance, consistency, and resilience. That's where fixed income comes in. For many investors, fixed income still means fixed deposits or traditional debt funds. But today's fixed income universe has evolved dramatically. It now offers access to a whole range of opportunities designed to generate predictable cash flows, manage risk, and potentially enhance portfolio outcomes. So has fixed income become one of the most misunderstood asset classes in investing today? To help us explore that question and to understand how investors should think about fixed income in a changing world, we have with us Nikhil Gite. He's the fixed income head of Neo Wealth and Asset Management. Nikhil, great to have you.
Thank you so much, Devina. I'm excited to be here. And as you rightly said, when we talk about fixed income, we typically think of FDs as an asset class, or maybe as an option to invest into fixed deposits or RDs. And at max, we can think of as some different way of investing into fixed income is basically debt mutual funds. But fixed income market in last a decade or so has gone much beyond that. You have direct corporate bonds where you can invest in. You have other opportunities like special credit opportunities funds, asset-backed securities, pass-through certificates. There are many more such instruments which are available into fixed income space. It is only that a lot of our retail investors are not aware that all these instruments are available, and even these instruments are made available for retail investors in lot of smaller ticket sizes as well. So it is just about creating that awareness, and retail market is one of the biggest market. I think in last so many years, retail participation has been a lot, and they have actually provided a lot of stability to our equity markets. So similarly, in coming years, we expect retail investors to provide that kind of stability into fixed income markets as well. And the central bank and government, they are actually trying a lot to make this kind of asset class aware to the retail investors as well. There are a lot of online bond platforms which have come in, which are actually giving investors a 1,000 rupee bond as well. So maybe a rickshaw driver or a taxi driver, or maybe a house help, they have also now started investing into fixed income market through these kind of bonds.
So what you're trying to say, Nikhil, is that this market is big. There is a huge opportunity, and there is an opportunity to make good returns, which are almost to the tune of about 11-12% is what you can make in this asset class without having sleepless nights.
So Devina, achieving 11%, 12% sort of return in fixed income market is very much possible. However, it is not that easy. You need to do your own due diligence before taking any call. Typically, you have to take credit in your portfolio. Now, when we talk about credit, typically people feel that credit is very risky. But that is again a misconception that people have. If you actually do your research well, you can actually very easily generate 11-12% sort of return. I will again say if you do your research well, because that is very, very important. I want to give one example. So typically, if you are giving your house on rent, so you actually try to do the due diligence of the tenant that you are going to keep. Then after that, you also see that will he be able to pay your rent or no. How long is he going to stay in your apartment? You also see if it's a family or if it's an individual. So while doing fixed income investments also, it is very important to do all these kind of due diligence. So basically, who is the borrower? Why is he taking money from you? Why others are not giving money to him? If we give them money, will they be able to pay us back? What would be the frequency of payment? And what happens if they are unable to pay? So all these factors should be actually researched upon. If you have answers to all, then only you should lend money to that particular issuer or maybe that particular borrower.
People usually talk about equities where they see, growth potential. Fixed income is looked at more from an income standpoint. But in the last 10 years, Nifty CAGR has been close to 12%, right? And we've been talking about how 12% is something that even in the fixed income space can be generated without risk-adjusted return can come to about 12%. So in that light, today our economy is growing at 6-7%. Our inflation stacks up somewhere close to 4 or 5%. So from an investor standpoint, even while looking at fixed income, I think 12% is something that they should look at, because that is the bare minimum that that such an economy should give you. So when you're building your portfolio, are you specifically geared towards companies who are going to be benefiting from this kind of a growth? Do you build portfolios in specific sectors that you keep in mind? Should you look at financial? Should you look at manufacturing? What kind of portfolio build out do you see?
From last maybe 10 years or so, India's economy has grown a lot. We have been consistently growing at, let's say, 6-6.5% of real GDP growth, about 10% to 10.5% of nominal GDP growth. Typically, our inflation has been about 4%. So, initially, what people used to think is that we should be able to beat inflation. But that is not the case anymore. Now, people think that we should be able to beat inflation by at least 300, 400 or maybe 500 bips in certain cases. Are there avenues to do that? In fixed income, yes. There are a lot of avenues. As I mentioned before, we have multiple instruments that are available to generate, let's say, double-digit sort of return. So having this sort of allocation to your portfolio is very, very important, wherein you are investing some money in, let's say, 10% sort of bond, you are investing certain money into 15% sort of bond, and there are multiple options which are available, which are giving you risk-adjusted returns, like special credit opportunities. There are multiple funds which are available in market, which are giving you about 20 to 23% sort of return. So even under your fixed income portfolio, you can diversify your portfolio into such different buckets.
But target an average of about
12%. As you rightly said, equity might be giving about 12-13% sort of compounding returns, and that is again with a lot of drawdown. 30-40% drawdown people must have seen in 1 month period or so. In fixed income, that won't be the case. You will have a predictability of about, let's say, 3, 4, 5 years, because these funds are typically of that nature, or maybe these bonds are typically will be having this sort of maturities of 3, 4, 5 years. So identifying such opportunity is very important, wherein you are getting 12%, 13% sort of return on year basis. So if you compound that, you will be able to beat equity easily in many cases. So a lot of these AIFs or these bonds of core credit, performing credit, or maybe special situation credit are becoming very popular. As we spoke about having a sleepless night, right? It is very difficult to have such nights. So what happens when you have these sort of allocations in your portfolio? You know that your money is not going to go anywhere. You are going to get a certain sort of return very stably in your portfolio.
You can have takeouts also, you can have distributions also, exactly. Or you can reinvest them also.
Exactly. So when you have the visibility, you can actually have a very peaceful sleep, and growing it at, let's say, 12-13% will give you long-term wealth as well. And it is a misconception that you can only grow through equities.
I think that has been the common thought process, that if you have to create wealth, it has to be through equities. For fixed income, you go for your regular stable income.
So let's assume, you rightly said, let's assume if you have, let's say, 60% into equity and 40% into fixed income. So if that 40% of fixed income investment is generating, let's say, about 12% consistently on year basis for next, let's say, 5 to 7 years, we have that visibility, right? In equity, you don't have that visibility. Let's say on the 60% of the portfolio, 1 year you're getting, let's say, 20%, but another year only 2-3%, another year maybe 10%. On an average, you're going to get about 12%. But there is no predictability. So in that case, would you rather invest in equity or would you actually give some more allocation to fixed income, where you at least know that what you are going to get in near future?
Ideally, when we're building a fixed income portfolio, what sort of diversification should one keep in mind? How much diversification is good diversification?
Actually give you, it again, depends on your investment goals and at what age you are in. How long have you been in financial markets? It depends on all that. However, let's say if you have 60% into equity, 40% into fixed income, under that 40% also, what I typically suggest is that you should keep about, let's say, 10% into very, very liquid assets, wherein if you have certain liquidity requirements, you should be able to sell that. There is enough and more liquidity available into fixed income markets. So that
without
10%,
taking a lot of hit?
Yes, 100%. So anyways you keep it not a very long duration, you keep it short to medium duration. So over a period of, let's say, holding period of 1-2 years, there is not much impact of the duration as well.
Okay.
Anyways, we don't suggest to take longer duration, but in 1 to 2 year segment, if you invest that to 10%, you will easily get about 7-8% in a very, very safe asset also. Then after that, maybe another 30% you should invest into, let's say, instruments which are giving you about 10 to 12%. And typically, RBI registered NBFCs are giving you that sort of return. They may be A rated, A minus rated, but rating is only the starting point where you should think of. As you mentioned before, you should also do your own due diligence before investing into such instruments as well. And another, let's say, 20 to 30% should be into bucket of, let's say, 13 to 15%. There you are actually taking little higher risk. That risk is there on paper. However, there are multiple options available in market wherein a lot of fund managers are actually doing that from very, very long time, and they have been able to deliver about 15% without losing any capital.
Basically, it's more opportunistic. You're also playing the rating lag. So sometimes these companies are up for rating, but the rating agencies are in a little bit of a lag. So you're expecting a rating upgrade to come. The company's financials are doing well. So it's mispriced at that point.
Right. So coming back to the allocation, I think about remaining 30% should be into, let's say, higher yielding categories. Again, that is on paper higher risk. However, for that higher risk, you are getting rightly rewarded of like 20 to 25%.
Okay, so Nikhil, if I was to ask you, when you're building such a portfolio, okay, fund managers have the experience, they know what to look for. But say, for example, if you were to point out 4 such things that while choosing a specific bond or choosing a specific fixed income investment, what should one look at from a risk standpoint?
So I would say, I think I gave an example of, while selecting your tenant, you do the whole due diligence. Consider this as, that way only. So typically, you should not lend money to companies which are very, very small. You should give money to companies which have enough equity buffer, and how you invest is also very important. I mean, the mode that you invest from is also very important. If you invest through NCD and you are secured investors, you have right of repayment. You have the 100% right of repayment. Apart from that, profitability. Second is profitability. You should be able to see, before selecting these companies, you should be able to see whether these companies are actually profitable or no. Are they able to run their business properly? I mean, at the end, the aim is to generate profit, right, for any company.
That's how they'll pay your interest also, no?
Exactly. So are they being able to do it and do it for a consistent period? It's not just 1 quarter profit or 6 months profit that should matter. You should select companies which are giving you returns for, let's say, more than 2-3 years of consistent profits. Then your confidence basically increases. So profitability is another factor that you should look at. Third important factor is the governance. How good are the promoters? Who are the promoters? Whether they have a dicey background, or they have been in market from very long time and they have
been successfly able to raise money from the market.
So all these factors are very important. So the governance of the promoter is very, very important. Again, it's very difficult for an individual or retail investor to reach out to such promoters or
get access to the information.
And again,
that's best left to professionals.
Right? So yeah. So this is the third, and fourth one is basically other factors of balance sheet, like whether that company has enough cash on their balance sheet to return your money or no. Another factor is if in case of NBFCs, how are the GNPAs and NPAs? Basically, for the loan, basically in NBFC is giving loan to another customer. So whether that customer is being able to pay this particular NBFC their money back or no. So all these factors are very, very important. So having a thorough check on balance sheet is very, very important. These are 3-4 factors I think are very, very important. And another one factor I would like to add, again that is very important. Is there enough liquidity available of these instruments in market or no? Because when you try to generate higher returns, liquidity might take some impact. So that's the reason while allocating in your portfolio, you should have 10% liquid assets and rest you can diversify into longer close-ended sort of AIFs or PMSs?
Keeping in mind, what's been happening to the economy right now, and where and which sectors do you feel is a good space to be in? See, we analyze sectors from an equity mindset. Now, to look at, like you said, alternate NBFCs, is consumption a good pocket to be in from a lending perspective? See, because ultimately when you're lending, you want to see stability of the company's cash flows. When you're an equity investor, you look at it from a very different lens. You look at it as to how fast the company is growing and things like that. How fast is the industry growing? Is it supportive or not? But in today's day and age, and at the interest rates that we are currently at, what are those sectors that you have identified where there is enough and more opportunity?
So typically when you invest in debt, you typically don't want to lend money to company which is growing very, very rapidly or very, very fast. Having a certain predictable growth is very important in these NBFCs. Let's assume that if a company is growing their business by 30, 40, 50%, but actually not doing the underwriting properly, then they might show growth, they might show profitability, but at the end of the day, their GNPA, NNPAs might increase. This I'm talking about NBFC sector. Yeah. So their GNPA, NNPA might increase. So as a debt investor, you would want your companies to grow at, let's say, 15-20%, have a predictable profitability, having a roadmap of, let's say, 3 to 5 years. So that is one. To answer the sector-wise question, so specifically after COVID, we are very positive on BFSI sector, specifically into alternative NBFCs, where they are actually making funds available to tier 2, tier 3, tier 4 city people. There is a lot of credit growth that has happened in last 3-4 years. So we are quite positive on these companies, alternative NBFCs, and again, if you choose rightly, if you do your due diligence, and if you lend money to these companies, your funds are not going anywhere, and you will generate 10, 12, 13% sort of return very easily without taking much risk. And to answer about the economy, we are actually growing at a very, very good pace, 6.5% minimum. And we have been doing that from last, let's say, 4-5 years very consistently. As a country, we are one of the fastest growing economy, and it basically also helps fixed income market to evolve. What happens is basically just to fund the deficit, the government comes in market and borrow from market through G-Secs and all. So there will be constant supply of G-Sec, and there will be a lot of takers also for G-Secs. So that market becomes very active and very liquid as well. A lot of foreign participation is also coming in, specifically into G-Secs, and very recently also governor announced a lot of measures to get foreign
participation
in fixed income debt. Another important factor is how balanced is your inflation and your growth. We have been growing at 6.5%, which is a good growth. However, in that transition, inflation for last year was much lower. It was very benign. However, this year it is expected to be at about 5.9%, and there is where we see risk. Also, there is a lot of geopolitical tension which was going around. In that case, because of the supply disruptions, inflation might go up. Secondly, you also have a lower base for last 2 years, because of which this year's inflation is projected at higher level. So what happens when the inflation goes up? Basically, central bank wants to reduce the demand in the market. So what they do is they basically come and increase the rates.
Correct.
So if inflation remains high, let's say it goes beyond 6%, if the inflation goes above 6%, you might see a couple of rate hikes coming in this particular year. If it remains below, let's say in the band of 4 to 6%, then we will see prolonged pause. And when the cycle again changes, the rate cut cycle will start. However, for this particular year, we expect yields to remain stable in the current range only. And overall economy is very, very resilient, very, very strong. During COVID also, there were a lot of measures taken. India was one of the, despite all the impact that came into our country, we were one of the fastest growing economy. We never, breached our fiscal deficits. We have actually reduced our fiscal deficits At that point of time, our fiscal deficit was about 6.5%. Now it is below 4.5%. So that's basically an indicator of how well your economy is doing.
And in that kind of a situation, fixed income, safe investments, risk-adjusted investments, portfolio building is a must.
100%.
Just want to wrap this up finally by just getting one view. Now that you've given your views on what is there a possibility to like how most people, when we look at equity investing, if there is a drawdown, you keep aside some money for investing at a particular level of the index, and then some profit taking. So in view of that, in fixed income currently where we are at, are you recommending people use this as an opportunity to invest or hold it out before we see the next rate hikes, if that is more of a plausible scenario?
You keep your portfolio duration in fixed income at a very low level, maybe less than a year, because if you have a horizon of, let's say, 1 to 2 years of investments in fixed income, then portfolio volatility becomes very, very limited. And as if there are rate hikes and if the yields go up, then you move from short term to long term, have some sort of duration there, and again when the cycle changes, yields will fall down, you will get the duration benefit, and you can easily generate about 10-12% or maybe more sort of returns from fixed income instruments as safe as G-Secs. So it's just about keeping it for a longer period and
actively
managing it.
Wow, so the way I have understood is, irrespective of what you do, 11-12% is something that you can very realistically achieve even in the fixed income market without taking any incremental risk. So even when you have a variance in terms of how the interest rates are moving, you can still end up making that. And even in a stable market, you can end up making that. But for that, obviously, you need to go with the experts. You need to go with the fund managers who've done this and who do this on a day-to-day basis. So very interesting, Nikhil. Thank you very much for throwing light on this. So I think this has been very educative in understanding how consistent, stable, cash flow throwing, regular income returns can be generated without causing very many sleepless nights. Thank you so much for watching.